So I set myself a challenge to trade an entire day using the RSI indicator. And the results? I made over $1,000 in gains in under 15 minutes. Then, during the last few hours of the market, I squeezed out another $415 using the same approach. Now, while I did make over $1,400 in gains, it's important to know that I had some losses along the way. So my true profit for the day ended up being $1,050. I did this challenge to show that it's possible to profit using RSI. In this video, I'll break down what RSI is and how it works. I'll also walk you through each of my trades, including the losses, because that's just a part of the game. Let's start with what RSI is and how to use it. If you're already familiar with this indicator, feel free to skip ahead to the live trades. Timestamps are in the description below. RSI stands for Relative Strength Index, and it's a popular tool traders use to measure the momentum behind price movements. In simple terms, RSI helps us see whether an asset, like a stock or ETF, might be overbought or oversold, which can help signal entry or exit points. RSI is calculated by comparing the average gains to the average losses over a set period, typically 14 periods. This default setting of 14 means that RSI looks back at the last 14 periods on whatever time frame you're viewing, whether it's a 1-minute chart, 5-minute chart, daily, or even weekly. RSI then divides those average gains by the average losses and plots this on a scale from 0 to 100. If the RSI is above 70, that usually signals the asset is overbought. An overbought asset is one that has been rising rapidly, possibly too rapidly, which often means it's more likely to see a pullback or fall. On the flip side, if the RSI is below 30, that indicates that the asset is oversold. An oversold asset has been dropping quickly and it might be ready for a bounce back up. In simple terms, RSI can tell us if the price is stretched too far in one direction. Generally, most traders see RSI crossing below 70 after being overbought as a signal to consider selling or even going short. On the other hand, when RSI moves back above 30 after being oversold, it's often viewed as a potential buy signal. RSI divergence is another helpful concept that every trader should know. Divergence happens when the price of an asset and the RSI indicator move in opposite directions. This can signal a potential trend change or give an early warning of a possible reversal. There are two main types of RSI divergences: bullish and bearish. Bullish divergence happens when the asset's price makes a new low, but the RSI doesn't go as low alongside it. In other words, the price is still dropping, but RSI isn't confirming the same weakness. This can be a sign that downward momentum is weakening, and a move to the upside might be coming. Bearish divergence is the opposite. It happens when the asset's price makes a new high, but RSI doesn't reach a new high with it. In this case, price is rising, but the RSI isn't showing the same strength, which can mean that buying momentum is fading, and a reversal to the downside might follow. Let's go through a couple of examples. First, we have the daily chart of Tesla. Looking at the RSI graph at the bottom of the chart, we can see that RSI was in an uptrend, starting in late December of 2022. Even though RSI was making higher lows, highlighted in yellow, the stock price was actually making lower lows, highlighted in orange. This is an example of bullish divergence. We can see that after the first 2 weeks of January 2023, the stock started rallying pretty quickly and ended up following the same direction as the RSI indicator. Next, let's look at a daily chart of SPY. Here we see the opposite. Even though the price is making higher highs, highlighted in orange, RSI is actually making lower highs, highlighted in yellow. After this, we can clearly see that SPY started selling off pretty quickly and started following the same direction of the RSI. Now, here's the thing. Just because RSI says something is overbought or oversold doesn't mean it's time to jump in and buy or sell right away. Markets aren't that predictable. I like to think of RSI as more of a heads up rather than a green light. It's like the tool is saying, hey, take a closer look, but it's not telling you exactly what to do next. This is where tools and indicators like support, resistance, moving averages, or even candlestick patterns come into play. When used together, these tools can help confirm whether it's a good time to enter or exit a trade. In my trades, I used RSI to spot potential opportunities, but I always paired it with other signals to determine the right time to act. Now, let me show you exactly how I did that. My trades were on Nasdaq futures NQ and S&P 500 ETF SPY. For the trading setup, I used RSI indicator to time my entries, but I relied on different confirmation signals for each trade, which I'll break down for you later. The first trade I took was on NQ. I saw the RSI was oversold both on 1 minute and 3 minute charts. The price bounced from the support and started trading above the orange trend line. Given the extreme oversold conditions of the RSI and as well as the bounce from the support, I got into a long trade hoping the price will retrace up to the resistance line at 20,349. For this trade, I used thinkorswim platform with my default NQ trading template. This template enters a trade with 20 points stop loss and 100 points profit target limit orders. For NQ, each point represents a 25 cents gain or loss. Typically, I adjust these levels to suit each trade, but this time I didn't have the chance. As soon as I entered this trade at 20,334, the price dropped quickly below my stop loss and took me out of the trade at 20,328.75. This all happened in just 1 second, resulting in a $105 loss. Not the best start to this challenge. However, seeing that support level at 20,320 held and the price seemed like it was ready to bounce, I re-entered the same exact trade but at a better entry price, 20,326. My stop loss in this trade was just under the support line. My profit target was near the upper resistance line at 20,349.50. The price rallied up to the resistance line and my profit-taking limit order got executed at $20,348.50, netting me about $450 in profits. The whole trade took me about 3 minutes. Even with the bounce, the 1 minute RSI stayed oversold and I noticed a potential double bottom pattern forming. For those who watched my last video on chart patterns, know the ideal entry for a double bottom is when the price breaks and closes above the neckline. In this case, the neckline aligned with the resistance line. So when the price broke and closed above the resistance, I went long at 20,350.25 with my stop loss just below the 9-period moving average in green. The price tested the 20 moving average line in white on the 1 minute chart and reversed back below the 9-period moving average, triggering my stop loss order and a $250 in loss. Looking back at this trade, a stronger confirmation would have been waiting for the close above the resistance on the 3 minute chart, which, as it turned out, never happened. But hindsight is always 20/20, right? For the next trade, I waited for a solid confirmation. The price dipped below 20,320 support with RSI still being oversold. However, when looking at the 1 minute chart, I noticed a bullish divergence. Even though the price has been making lower lows, the RSI indicator was actually making higher lows, hinting that the downtrend might be losing strength. On the 3 minute chart, I also saw a morning star pattern forming. I waited until the third candle and the pattern closed above what was now the resistance line before I entered this trade. Another good sign was that the RSI was slowly climbing out of the oversold territory and looked ready to cross the 30 line, which, as we stated before, was a buy signal. I entered long on the following candle at 20,321.50, setting my stop loss 20 points below the support line. My profit target was again near the upper resistance line at 20,349.50. The price bounced and hit the resistance line, at which point my profit-taking limit order got executed at 20,348.50, netting me $540 in profits in just under 10 minutes. Including the first loss of $105 due to not being able to adjust my stop loss in time, I made over $635 in profits trading NQ. After trading NQ, I decided to check the price action for S&P 500 ETF SPY. I noticed that the price had been declining since market open, and the RSI was oversold on both 1-minute and 3-minute charts. But on the 1-minute chart, it was forming a bullish divergence. I also noticed that the price was approaching a support line, and I knew that if I wanted to take a long trade to capitalize on potential bounce, it had to be off the support line. I just had to wait for a confirmation. I entered the trade when I saw the support held, RSI crossed above the 30 line, and the price closed above the 9-period moving average in green both on the 1-minute and 3-minute charts. Unlike the NQ trade, I went with 10 0DTE call contracts on the SPY with the strike price 577. The whole trade cost me $220. My profit target was the resistance line at the $578. My stop loss was if the price broke below the 9-period moving average line on the 3-minute chart. I closed half of my position when the price started consolidating near the 200 exponential moving average line in yellow on a 1-minute chart. This netted me about $360 or $140 in profits. Given the 1-minute and 3-minute charts, I believe that with the consolidation, the price was forming a bull flag pattern. However, when it broke below the 9-period moving average on the 3-minute chart, I decided to close the remaining 5 contracts, netting additional $275. So in total, I made $415 in profits from trading the bounce in SPY. By the market close, the price indeed reached the 578 resistance level as I initially predicted. However, I'm not too sad with the trade as I was happy with the profits I made for the day and didn't want to take more risk to see if the price would eventually reach to the resistance level, especially after considering the extreme volatility and time decay of the 0DTE options. These examples show that RSI isn't just a buy or sell signal. It's more like a check engine light. Use it to flag potential opportunities, but confirm with other signals before you make a move. If I went with RSI alone for all these trades, I wouldn't have seen the same results. That's why RSI works best when combined with other tools. Do you want to get a better handle on using RSI with other patterns? Then check out my videos on chart patterns, candlestick patterns, and how to identify support and resistance. If you enjoyed this video, click like, comment, and subscribe. It helps the channel a lot. Feel free to drop a comment below on what you would like to see next. I've got a lot planned, but I want to make sure it's what you're here for. Thank you for watching, and I will see you in my next video.